Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals in our 25th year of business. It's midday, Thursday, July 31st, and the title of this week's audio blog is The Rapidly Approaching Emperor Has No Clothes Moment. When the history books are written, it won't take rocket scientists to decipher the simplicity of how the global economy collapsed. Through simple perusal of the past, journalists will understand that all fiat currency systems inevitably end in hyperinflation. Only this time, it wasn't an individual fiat currency, but all 180 global fiat currencies. Via the immutable laws of mathematical physics, the weakest currencies were consumed by inflation first, followed by the larger ones, until finally the world's reserve currency itself imploded. The timeline couldn't be easier to analyze, starting with the 1944 decision to cede the lone financial survivor of World War II with said reserve currency status at Bretton Woods, New Hampshire. Once that privilege was thoroughly abused, the next key event occurred, i.e., when the holder of the reserve currency reneged on the gold standard in 1971, with not a single nation uttering so much as a peep of protest. After 29 years of unfettered global money printing thereafter, the credit card afforded to global governments by the lack of gold's discipline was fully charged up, yielding an historic, potentially permanent, global peak in economic activity in the year 2000. Ironically, this occurred within months of the new millennium, an event that had engendered such an enormous amount of goodwill and hope. By 2008, the emergency measures taken by central banks to avoid the inevitable economic crash imploded upon their own weight, in essence, permanently destroying the global banking system. At this point, unprecedented liquidity was injected into the market, but by late 2011, the system was within a hair's breadth of a second cataclysmic collapse in 3 years, including, of course, a record high in global gold prices. At this time, per what I wrote in The Point of No Return, the powers that be realized their only remaining tools were massive, in large part covert, amounts of money printing and market manipulation, along with an historic propaganda scheme that would make Goebbels blush. Amongst the key buzzwords of this campaign, the most prevalent were recovery, tapering, and the weather. Not to mention the time-honored characterization of precious metals as barbarous relics, even when they are actually earning more than some financial accounts that were having negative interest rates. In 2013, when global economic activity plunged further, an all-out assault was made to quash gold and silver, whilst the power that be prepared for the inevitable economic collapse. Simultaneously, stock and bond markets were goosed to record valuations, signaling the oncoming hyperinflation to the few observers shrewd enough to see through the propaganda and embrace reality. And finally, 2014 arrived, with nearly the entire world joining the hyperinflation train. The issuer of the reserve currency made one last attempt to buy time by hyperissuance of both propaganda and money, but as the entire world realized this emperor had no clothes, their seemingly limitless power imploded into the dust, and with it the value of the dollar itself. Which is exactly where we stand today, as the second half of 2014 begins. This time around, not only are individuals and municipalities broke, but sovereign governments and the central banks that fund them. In other words, they have zero ammunition left to fire, other than unvarnished hypermonetary inflation. Japan's hopeless foray into the ultimate money printing scheme, Abenomics, has failed miserably. China's historic real estate and construction bubble is imploding. The ECB has taken European interest rates to negative territory with a new trillion-dollar QE program on its heels. And the Federal Reserve is on the verge to ZERP to infinity, with QE to infinity right behind it. By my view, this week's toxic events have moved the world closer to the Fed's emperor has no clothes moment more rapidly and irreversibly than any before it. Will Jim Sinclair be right that gold will hit $2,000 by year end and possibly far higher? Or will we have to wait until 2015? Either way, the window of opportunity to protect oneself is getting tighter with each passing day, ultimately to permanently snap shut for posterity. Heading into this week, it was patently obvious the powers that be would do everything in their power to reverse expanding negative sentiment about the global economy, let alone equally expanding positive sentiment regarding real money, as despite the most gargantuan cartel efforts yet, both metals have surged above their 50 and 200-day moving averages amidst an environment of rapidly dissipating global economic activity, as depicted by the nearly all-time low of the Baltic Dry Index. After all, there were a slew of key attack events to work with, from Monday's COMEX options expiration to Wednesday's ADP employment and GDP reports, and an FOMC statement, and the COMEX first delivery day, to Thursday's, that is today's, Chicago PMI diffusion index, and last but not least, tomorrow's NFP report. However, their initial plans to propagandize recovery were soundly smashed by the utterly horrific earnings posted by Amazon.com, which actually lost money on an operating basis and warned of massive losses in the third quarter as well. As I subsequently wrote in Need or Want, Demand is Dying, Amazon.com is to want spending as Walmart is to need. And following last month's comments from Walmart's CEO, who was subsequently fired, that consumer demand is succumbing to a weakening economic environment, Amazon made it plain and clear that discretionary spending is falling dramatically. After the anticipated, blatantly obvious capping of gold and silver for Monday's COMEX options expiration and a relatively quiet Tuesday, we reached the week's main events. To start, ADP reported a significantly weaker than expected jobs number, including just 3,000 manufacturing jobs in a population of 321 million. And heck, how many of them were full-time and how many were part-time, we'll never know. However, with Whirlybird Janet scheduled to speak that afternoon, the powers that be were going to do everything in their power to cover her, starting with another blatant PM raid and perhaps the most transparently fraudulent economic report to date. Yes, amidst a quarter in which not a single indicator of real economic activity was much more than flat, we were told GDP increased by 4%. As I wrote in yesterday's 4% World, there were so many aspects of the report flashing warning signals, it nearly put the monthly jobs data propaganda to shame, as exemplified by the fact that half the so-called growth, not just for the second quarter, but the entire year, was due to inventory building, and you've seen what GM has done with its record channel stuffing. It couldn't be more obvious that something was amiss, let alone that, quote, personal consumption was estimated to have risen 2.5%, despite retail sales data indicating only 0.8% growth, and better yet, durable goods spending up a whopping 14%, whilst durable goods orders rose by just 0.5%. When all the revisions are said and done, I'd be shocked if the final number wasn't a lot lower, just as was the case last quarter. Of course, even if not, it matters not, as by then the entire world will have started to realize just how fraudulent this data is. Following the GDP report, PMs were of course attacked, when are they not? And the all-important 10-year yield rose from nearly its post-taper low of 2.45% to the low 2.5% range, as there was simply no way the Fed would be allowed to speak in an environment of multi-year low interest rates amidst the so-called tapering campaign deemed to signal economic recovery. We deem this seeming paradox to be the most damning proof yet of QE failure, and in the coming months and years, expect the 10-year yield to fall to a Japan-like zero until, of course, said hyperinflation arrives like a Japanese-style tsunami. Gold actually recovered to end yesterday, that is Wednesday, at $12.96 per ounce, and for the umpteenth time in the past week, and I do mean umpteenth, was capped when it attempted to rise above the key round number of 1,300 per ounce. Likely, as the powers that be were full well aware of what was coming later that morning. And this despite renewed fears of European bank contagion, as Portugal's largest bank moved closer to bankruptcy, and oh yeah, the all-out default of Argentina on its sovereign bonds. Amid such a wildly PM bullish environment, when, quote, employer costs were reported to have risen a whopping 0.1% above expectations. Just after the comics open, of course, PMs were again attacked. Such a statistic is highly questionable in its own right, let alone whether it's even important, which it's not, as the simultaneously published Challenger mass layoff report exploded higher during a week when major corporations like Microsoft and Amgen joined the layoff parade. In fact, when the CEO of Aetna, America's third largest healthcare provider, was asked what he thought of the economy yesterday morning, he said he was still seeing, quote, layoffs and group attrition in the large employer segment. But hey, when the cartel is on a mission to break gold's 200-day moving average and get those sell stops to be hit by the paper traders, no data is safe from fabrication or market from manipulation. Clearly, the powers that be were well aware what was coming an hour later, and when the 10-year rate's brief Fed-aided surge was stopped at exactly the 2.6% yield we have long described as the line in the sand depicting the aforementioned most damning proof of QE failure, I sensed something was very badly wrong. Sure enough, at 9:45 a.m. Eastern Standard Time, the principal propaganda tool on the U.S. Island of Lies, that is the Chicago PMI Diffusion Index, came out so bad I had to do not 2 but 3 looks at my screen to make sure my eyes weren't deceiving me. Yes, the so-called proof of economic recovery that the MSM has trumpeted all year, despite the reams of contrary indisputable evidence I have presented, was so bad even the nation's top propagandists are likely speechless. Coming in at 52.6 versus last month's 62.6, and by the way, it was expected to be, in the low 60s again, there is simply no way to assume anything other than a dramatic decline in economic sentiment, which frankly is far more reflective of the current reality, both here and overseas. Rates have fallen back to 2.55%, that is where they started the day, and equities are getting hit very hard, with the Dow down incredibly 210 points. Can you believe that? It's down 1.2%. It's down more than its 1% limit day loss of the PPT. But of course, in an environment where people are so jaded by markets not being allowed to fall, 200 points might as well be 2,000 points. Anyway, the cartel is so desperate to try to prevent gold from recapturing its 200-day moving average of $1,287 per ounce, that such a shallow veneer will likely be swamped in reality and real order anyway, particularly given the historically oversold condition that ultra long-term indicators are demonstrating, as we discussed last week in Are You Ready for a Moonshot? I look forward to tomorrow's NFP report with bated breath, as now that ADP's seemingly sole goal is goal-seeking its way to the BLS's methodology, likely using the same unsubstantiated adjustments, it would appear difficult for the BLS to somehow report a significantly better than expected number. And even if they do, the fraud involved would likely be seen right through, let alone the horrific internals that have characterized every NFP report since the global economy broke in 2008. With the global economy in freefall, potentially major military confrontations in the Ukraine, Israel, and Iraq, and renewed decline in emerging market currencies, the odds that the powers that be will be able to hold things together in the second half of the year appear extremely thin in my view. And thus, why anyone would not find it prudent to take financial precautions beforehand is beyond me, at the least covering a small portion of their assets. The fragile house of cards could crumble at any time, and when it does, if you haven't already protected yourself, it may permanently be too late. For those taking the initiative to protect themselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with any questions you might have at Hoffman@milesfranklin.com. Thank you, and have a great weekend.